Good Wednesday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH, or should I say, happy the day we all dread, April the 15th. It's almost here. You got till midnight. Put that money in the mail or put the tax return in the mail or however you decide to do it, electronic filing, etc. But it is April the 15th, isn't it? That prompted me to bring up a great topic for you this afternoon. After I go through the stock market recap, and what a day it was, what a recap I'm going to be able to give you, because it was a record-setting day for the NASDAQ and the S&P 500. That's right. Can you believe that? After everything we've gone through, we closed at record levels for those two major averages. A little bit light on the Dow side of things, but record-setting day for the NASDAQ and the S&P. Going to give you all the reasons behind it, what moved in your portfolio today probably, etc. But let me tell you about my topic this afternoon. I'm going to give full credit to Bloomberg. Love Bloomberg. Love the information. I know many of you don't like it because it's a left-wing news source, but for those of us in the industry, we pay a lot of attention to it. They do an incredible job of reporting and really great job of various types of stories. That's what I thoroughly enjoy about it. Definitely worth the subscription that I pay for. But let me tell you what I came across. And it was yesterday, and I've saved this topic obviously for today because, of course, it being April the 15th. And you're probably sitting back going, oh, I can't believe the amount of taxes I had to pay. It's not fair. Why did I have to pay so much? What did my accountant do wrong? It's not fair. Why do people that make millions of dollars pay less in tax than what I do working a W-2 job? Well, what many of you may not realize, and I'm not saying that from a criticism standpoint, it's just things have changed a lot, like everything in our lives these days. Things have changed a lot with the big, beautiful tax bill. And this is the first year that certain types of professions pay a heck of a lot more in taxes than other professions. So as I was perusing Bloomberg yesterday, I came across this story that I'm going to be focusing on after my stock market recap. And the title of the story is "The Salary Penalty: Why Trump's Tax Bill Hits a Banker Harder Than a Plumber." I mean, what a headline that is. The tax bill hits the banker harder than the plumber. So it caught my attention. And I started going through this article and I went, oh my gosh, what a phenomenal topic for the show on April the 15th. Because again, as you write your check to the IRS, or for those of you in California or other taxable states, writing your check to the IRS and to your state, you're probably not too happy about it. Well, after today's show, hopefully I can enlighten you a little bit about the way that you are making money, and therefore the tax liability or lack thereof that you're susceptible to. We've all heard the adage, it's not what you make, it's what you keep. And as I've always emphasized to our clients, and I think I've mentioned it many times on the show over the years, tax planning does not happen, obviously, in the year the taxes are due, right? You don't plan for 2025 when the calendar rolls on January the 1st. Matter of fact, you don't even plan for your taxes in October or November, in this example of 2025. Tax planning, especially if you have any wealth, occurs on a 12-month basis. And I'll be honest with you, it's almost unfair when I look at tax returns and guide my clients on tax strategies. The amount of taxes that people have to pay when they are retired, but not in all cases, just in a small case of the retirees, but predominantly where my heart bleeds is for those of you, which is the vast majority, that work for someone else, that you're a W-2 employee. That doesn't say you work, it doesn't say that you work less hard or harder or anything else than the self-employed individual. But you see, as you're going to learn this afternoon, the tax codes are definitely slanted towards those of us that are self-employed. And for those of us that have a level of knowledge and education and are self-employed, the pendulum really swings our direction. I'll give you a real brief example. If you fit a certain criteria, those of you that are business owners, and I hope you take me up on this offer. If you fit a certain criteria, meaning a certain age of you as the owner or the owners and a certain income level, and I'm telling you there's ranges here, but again, I'm not going to go into the details. There's one of the most incredible retirement plans that you probably never heard of before. As a matter of fact, we just implemented it at our firm. It's called a cash balance plan. Remember the old days where you'd get a pension? For those of you, and some of you still may, but very few do. That's kind of the fundamental of a pension plan. It's called a cash balance plan. And what it allows you as a business owner, again, fit all of the criteria, what it allows you to do is to shelter huge sums of money pre-tax for a certain number of years. And when that time period is up, whether if you hit a certain age, meaning usually of age of retirement, like 65, and a few other criteria, all this money, and I'm talking dependent upon your income and your age, it can literally be hundreds of thousands of dollars that you business owners can sock away into a cash balance plan in combination with your Safe Harbor 401k plan, which is a 401k, a profit sharing, and a company match. Got to have all those kind of mixed together. And you are sheltering hundreds of thousands of dollars, again, if you hit the criteria, that is reducing your taxable income. So imagine if you had taxable income of, I don't know, 500,000, a million, and you could take hundreds of thousands of dollars off the top of that, put it away, reduce your taxable income. Let's say you're able to shelter $500,000, which in these plans, again, certain criteria you can. Now your taxable income went from $1 million down to $500,000. That's money that's growing for you in retirement. It went in pre-tax. It's growing tax deferred. And when you hit retirement, guess what? You can either create a pension off of it, or you can roll it over to an IRA and manage it any way that you want to. See, unfortunately, that great plan, and that's just one of many strategies that we have, that great plan is only available to small business owners. For everybody else, that's a W-2 wage earner. There's not a lot of deductions left anymore. And that's the problem. That's the challenge that many people face, especially if you're a dual income, it's very easy to be making a couple $100,000 a year. But that's the sweet spot from the tax perspective of the tax rates, et cetera. And what can you write off these days? Maybe your mortgage, but many people, the standard deduction doesn't allow you to itemize anymore, meaning to take the mortgage deduction and other things. So I hear it over and over again from people. It's like, my gosh, I make a great living, but I have nothing I can write off. And especially for those of you that are retirees, the house is probably paid for, you got decent income coming in, and there's no tax write-offs. So the reason I'm bringing all this up is to say, okay, here we are, April 15th of 2026, still very early in the year. You still have time to start planning for your 2026 taxes. Because come this time, April 15th of 2027, I hope that what I cover with you today will open your eyes, whet your appetite a little bit, and you'll reach out to us or your CPA or whomever and really get involved in your tax planning. Because again, it now has become a year-round responsibility. The old days, it wasn't, right? When we were able to itemize everything, it's like, okay, I'm a W-2 employee. I can do this, this, and this, and that's about it. Well, now that list is even smaller. But what has really changed with the big, beautiful tax bill is dependent upon what industry, this is what's really unique now, dependent upon what industry you are in, it can have a significant impact on the amount of taxes that you pay. And so this article that I'm going to share with you goes through the example of a lot of different kinds of people. A Wall Street banker making $1 million, a plumbing company owner, a retired CEO, a venture capitalist. And you're going to be amazed on the same amount of income, how much taxes they pay because they are in different industries. But then we'll get down to the high school teacher, the steakhouse server, the police officer, and the retired electrician. And you're going to be blown away also at the different amount of taxes and tax rates that these individuals pay. Because I'm sure many of you are aware, especially if you're in the in any industry that you're able to earn a tip, guess what? You can make a whole bunch of money, like $25,000 in tips, and basically pay no income tax on that $25,000. It's part of the big, beautiful tax bill. A lot of people are upset with that, but it is what it is. So your responsibility is, again, to become Mr. Tax Planner. Have a great team, your financial advisor, your CPA, your attorney if you're a high net worth individual, and plan for this. Because, folks, it is a different world now after the passing of the big, beautiful tax bill. It's not, again, the amount of money, it's the industry you're in that really dictates what your tax rate and therefore your tax bill is going to be. So I'm very, very excited, as you can tell by the passion of my voice, to share this story with you and to kind of educate you as we go through it. Because it's the new world that we find ourselves in. And, I don't think there's any better day that we're all focused on our taxes than today, April the 15th. All right, so I'll get to that when well, we'll come back. We'll already hit our first break right now. My goodness, time is flying. We'll come back. I'll tell you what happened in the market today. Like I said, record-setting day for the Nasdaq and the S&P. Get that out of the way, and then we're going to move into our topic. Again, I've titled it "The Salary Penalty: Why W-2 Earners Pay More in Taxes Than Just About Anybody Else." Let's turn it over to Kristen Snow. She's in the Right Now Traffic Center. Hello, Kristen. Come back to the Jon Sanchez Show on News Talk 780 KOH. Happy Tax Day, April the 15th. Well, record-setting day for the S&P and the NASDAQ. I'll cover that now, but as a reminder, I'll be getting to my topic this afternoon, the salary penalty, why W-2 workers pay more in taxes than anybody else. All right, to the market. Well, it was kind of sloppy throughout the day on the Dow Jones Industrial Average. Just never really could get much traction. And we finished just modestly lower, down 72 points to a close of 48,463. But as I said, a record-setting day for the NASDAQ and the S&P 500. The NASDAQ for the session rising 377 points, 1.6%, closing at a record of 24,016. The S&P rising 56 points, 0.80%, to close at 7,022. Hit 7,026 intraday, but again, 7,022. A record close. And think about that again for a second, folks. Pretty remarkable considering everything that we've gone through, right? And now here we are at record levels on 2 out of the 3 major averages. There was no specific catalyst behind it. We had some import prices, export prices. I won't bore you with that. We had the Fed beige book. Won't bore you with that. None of that really mattered to the market. What the market is focused on right now, of course, is Iran. And with the president coming out yesterday and reiterating it again today that the other side wants to make a deal. We're talking about having another second round of negotiations. That's all it took. That's all. That's what the catalyst, from yesterday's stellar gains to today. I mean, if you missed what happened in the market yesterday, let's let's go back to that. We had a gain of 317 on the Dow yesterday, a gain of 455 on the Nasdaq, and a rise of just 8 on the S&P 500. So let's just take the Nasdaq, right? 455 points yesterday, up 376 today. What are we at? 800-point gain in 2 days? Come on, that's not normal. But this market, again, a lot of pent-up demand, as I've been saying. There was a lot of cash sitting on the sidelines. Investors are hungry for deals. And boy, are they finding some of those. Not so much now after these big run-ups these last couple of days, but boy, oh boy, if you would have bought when this market was having troubles, in certain areas, and I'm talking specifically in technology, my goodness, you would be up very nicely. What are some of those names? How about Microsoft? No one wanted to touch the stock a week ago. Yesterday, big run up. Today, $18.11 gain, 4.61%. Now at $411.22. The dog up $10.49, 9.5% to 121.06. ServiceNow, another one nobody wanted to touch a couple weeks ago, rising over 7% today, $6.40 increase. Then we move into the semiconductor area, and not quite so fortunate. This is one of the areas that was weak today. Again, we're finding hot days, cold days on that. Remember, Tesla was real strong. And NVIDIA was very strong yesterday. Well, today you had the likes of SanDisk down $52 and some change, about a 5.5% loss. KLA-10 Core losing $47.80, 2.66%, etc. Meta was another standout. Again, stock was beaten up a few weeks ago, rising $10.60 today, 1.6% to $673.10. Tesla had a wonderful day today, $27.75 gain, 7.62% to $391.95. Again, another one. We had Bank of America report earnings numbers this morning. Very, very strong performance with the company overall. Caterpillar was one of the pressure points. That's the reason the Dow just did not do anything today. Stock was down $24.08, about a 3.03% loss to 770.17. A recent Fed commentary suggesting that rates are going to remain unchanged for some time in response, of course, as we warned about that the Fed said, oh, not a problem. Well, guess what it is? Oil-driven inflation, right? And so this sector where Caterpillar is, Carrier Global, so on and so forth, very susceptible to higher rates given the capital-intensive nature of their businesses. So that's why Cat's been suffering a little bit. But hey, let's go to the year-to-date numbers. Looking pretty good here, as I covered yesterday. Now the Russell 2000 year-to-date up 9.3%. NASDAQ is higher by 3.3%. S&P's up 2.6% year-to-date. And the Dow, almost a 1% gain, up 0.8%. So like I said, very quiet on the news front. No real news coming out of Iran, the blockade, nothing like that. So it's an example of what happens in this market, right? When two things happen. Number one, there's no bad news regarding Iran and oil. And number two, when there's that, as I keep calling it, the golden carrot that Trump keeps waving out there saying, we're going to have another round of negotiations. Things are going good. The war is over. Da, 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 da. That's all these investors want to hear. and they buy everything up. And so we'll keep this momentum. But there is no complaints whatsoever. We are enjoying it while we can, because as we all know, things can change with a simple True Social post or a comment or anything along those lines. So with that said, I'm going to get started on my my topic today. April the 15th, right? Many of you are not having a good day today. You had to write some big fat checks to the IRS. And if you live in a taxable state, to, of course, the state treasurer. You're going, how did this happen? Where did I go wrong? Well, as I said in the first segment, many people are not aware that now it's no longer the income that you make that really determines your tax liability. It's the industry that you make that money in and what type of way that you've made it, whether you're a business owner, a W-2 employee, a retiree, or as you're going to find out, a venture capitalist, which by far is the best one to be, as you're going to learn here shortly. So again, I want to thank Bloomberg for this incredible story. I give them all the credit. Fascinating. So let's kind of just start off with the major headline, which is not all millionaires are created equal, right? At least that's according to the IRS. These days, the biggest factor determining what high earners owe the government is how they make their money. And for the rich and the middle class alike, salaried professionals tend to pay far higher rates than other Americans with equivalent incomes. I'll give you a quick example before we go to break. Let's take a banker, okay? Married, filing jointly, pulling down $1 million salary. Now, she can easily owe more than $300,000, so 30% in federal income tax. And then, of course, state income tax if applicable. Now, this calculation is according to a partner at the accounting firm UHY-LLP. But guess what? That's $60,000 more than business owners and $100,000 more than investors who earn the same amount. That's right, investors. Not bad when you're a retiree if you're an investor, if you do it right, as I'll explain. So exploiting a break expanded in last year's tax law, right? The big, beautiful bill. Did you know that a millionaire venture capitalist can bring that $1 million income, can literally bring it down to a tax liability of zero? You heard me right. Make $1 million as a venture capitalist, your tax bill, zero. According to John O'Farrell, a venture capitalist and former general partner at Andreessen Horowitz, their big venture capital firm, he said the following quote. He said, there are dirty little secrets to this business, meaning the venture capital business, that are highly lucrative for those who are familiar with them. Now, remember, the president has now twice expanded the tax breaks for millions of Americans. His policies pursue traditional Republican priorities like tax cuts for businesses and tax cuts for the wealthy. They also reflect a populist MAGA worldview, one that defines elite not by how much money people make, but again, how they make it. Because under Trump's tax regime, salaried workers face comparatively higher tax burdens, and well-off professionals like doctors and lawyers are explicitly barred from one of the most lucrative of the recent tax breaks. Yeah, count me into that one. Meanwhile, rewards flow to investors, business owners, and people making tips and overtime. By helping these small but symbolically important slices of the workforce, the policy elevates Trump's base over college-educated Americans who have consistently voted for his opponents. You see, college graduates went for Democrats in the last 3 presidential elections by an average margin of 20 points. That's according to Pew Research Centers, where people without bachelor degrees favored Trump by an average of nearly 10 points. Among the more educated voters who have publicly embraced MAGA are some prominent Silicon Valley venture capitalists. And I'll stop right there as we continue our discussion, the salary penalty, why W-2 workers pay more in taxes. Let's turn it over to Jack Saban. He's got news, traffic, and weather. Hello, Jack. Back to the Jon Sanchez Show on News Talk 780 KOH. Happy Wednesday to all of you. Happy tax day. We're focusing on the salary penalty, why workers, W-2 that is, W-2 workers pay more in taxes than anybody else. All right, we're going to continue our story, but first I want to give you some breaking news that came out right as I was wrapping up the last segment. I have not had a chance to really delve deep into this, but I want to share it with you. Spirit Airlines said now they can liquidate as early as this week, according to people familiar with the matter. Of course, we know the carrier has been struggling for quite some time. The Spirit said in a statement, we don't comment on market rumors and speculation. Let's see, the exact day the carrier could begin liquidation wasn't immediately clear. Bloomberg earlier reported on the potential liquidation. So no confirmation from the company yet, but That could be interesting. I'll keep an eye on that one. All right. Once again, it was a record-setting day for the market, at least on the Nasdaq and the S&P side of things. Nasdaq rose 377, 1.6% increase. S&P gained 56 points to a close of 7,022 record, and the Dow today was down 72 points. All right, it's April the 15th. We're all, our hands hurting from writing checks to the IRS, to the state, etc. But you know what? One thing that's changed, it's not how much money you make, it's how you make it, right? So I'm going to continue going through this incredible Bloomberg article, again, sharing with you how different people pay different amounts in taxes on the same income, okay? So let me start with an example with you, okay? So we'll start with some high income earners, and we're going to break it down between a banker, a plumbing company owner, a retired CEO, and a venture capitalist. Okay, you ready for this? Okay, so again, setting the table, they all make $1 million, okay? The Wall Street banker, again, rights or survivors, files joint tax return with her spouse. Okay, so she makes $1 million in W-2 wages. Her ordinary federal income tax would be $283,000. Okay, but what, 28.3%? Her payroll taxes add on another $32,000. So total federal tax she would be paying would be $315,000 or 31.5%. That's your high income earning investment banker. Now let's go to the plumbing company owner. He makes the $1 million, but his federal income tax is $199,000. His self-employment tax is $55,000. So you total that up, his tax bill is $254,000 or 25.4%. So 254 versus the W-2 banker at 315. Because why? He gets deductions, right? How about the retired CEO? So remember, before I get to the retired CEO and how he or she makes their money, remember what the wealthy do. They borrow, die, and have zero tax, right? When you see the big stories that I share with you every day on this program of a CEO, I don't know, Larry Ellison of Oracle comes into mind, the big Paramount deal that he helped his son do, they needed billions of dollars. These CEOs and executives, they don't sell their stock, right? Their wealth is tied into the company stock, the company that they founded or that they run, right? That's where their wealth is in that stock. But do you think for a minute they're going to sell the stock and pay upwards of 20%, sometimes higher, obviously? 23 can be the max, 23.5. In capital gains tax? Heck no. What do? They go to their favorite Wall Street bank and they go, hey, look it, I'm going to pledge, 1 million shares of my company. Give me a loan against it. And so they get a loan against it. Doesn't trigger any taxable capital gains. And then, of course, they just continue, make the interest payments, et cetera, on it. And then at some point they die. And then whoever inherits that stock gets a stepped up cost basis. So let's say their kid inherits it. All that capital gain is gone. Same thing happens on real estate. So let's go to our retired CEO, right? He makes $1 million, but he makes it in long-term capital gains, qualified dividends, and carried interest. So his tax bill would be about $174,300 in capital gains tax. Net investment income, about $28,500. So his total federal tax bill is $202,800. So let's compare that back to the banker, the W-2 banker, whose tax bill is $315,000. The retired CEO's effective tax rate, 3% versus the banker at 31.5% and the plumber at 25.4%. But if you think that's good, many of you may not be aware of this one. I always said I should have become a venture capitalist. This is the reason you want to be a venture capitalist. Because you see, a venture capitalist, I have to laugh. I'm sorry. I have to laugh at this tax rule with what's called the Qualified Small Business Stock, or QSBS as we call it. The QSBS break allows investors and employees with early startup stakes can pay no taxes on any gains up to $10 million or 10 times their initial stake, whichever is greater. Let me repeat that. They pay zero tax on income or gains up to $10 million or 10 times their initial stake. Last year, that cap, 2025, was increased to $15 million for stock acquired going forward. So when you see these venture capitalists on CNBC or Bloomberg TV or wherever you may see them, don't let them fool you for a minute. They can make up to $15 million and pay zero, zero, zero federal income tax. The wealthy keep wealthier. All right. Now, let's go down to the hardworking man and woman, kind of middle class. Okay. We're going to take a look at somebody that's got an $80,000 income. We're going to look at a teacher, a steakhouse server, a police officer, and a retired electrician. Okay. So the high school teacher, right? Tough job. 40 years old. Makes all these people make $80,000 a year. Listen to the difference in the tax rules, tax amount. So again, this high school teacher, he pays $9,500. Again, this is considering that he's single with no dependents. All these people are single, no dependents. So this high school teacher making $80,000, 40 years old, he pays $9,500 in federal income tax. He pays another $6,100 in employee payroll taxes. For his total federal tax bill of $15,600, 19.5% effective tax rate. Okay. Now let's go to one of the biggest beneficiaries of the big, beautiful tax bill. Those that can make money via tips. So let's take a steakhouse server, and she makes $80,000 a year, including, many of you may not be aware of, $25,000. That's right. A person that works in a business that they collect tips from last year through the year 2028. If they are single and they make up to $150,000, they can make $25,000 in tips and pay zero income tax. If they're married and file jointly, they can make $300,000 and make up to $25,000 in tips and pay zero income tax. So listen to this one on our steakhouse server who's single. She makes $80,000, of which $25,000 is tax deductible tips. Her federal income tax is only $4,600. Payroll tax is $6,100. Total federal tax $10,700. Effective tax rate 13.4. So look at, she's essentially paying almost $5,000 less in federal income tax, same income, than that poor teacher that definitely works hard. All right, let's go to a police officer. Okay, $80,000, including about $12,500 in deductible overtime. Same thing, age 40. That hardworking man or woman pays $6,700 in federal income tax. Payroll tax is $6,100. Total federal tax $12,800, or 16% effective tax rate. But what about that retired electrician or business owner, whatever you want to call it? He makes $80,000 in pensions and Social Security, and he's 70 years old. Well, federal income tax, $5,000. Well, tax, obviously, zero. So his total federal income tax, $5,000. Effective tax rate, 6%. So you see how the numbers work out, folks? Same income, same tax filing status, but completely different tax rates. And that's what this whole thing is about today. It's all about where you make your money and how you make your money. And therefore, that is where a great determination comes in on how much income tax you are going to pay. And again, I don't have a lot of time, so I could really go into some significant details and other strategies with you, but I think you get the point. It no longer is, I make this amount of money, my deductions are this, and therefore I know what my tax liability is going to be. Think about the way you make your money. Let's go to many of you that are 70 years old or older. Under the big, beautiful tax bill, you're now eligible for a new enhanced $6,000 perk. That's right, $6,000 perk, which means a 70-year-old with $80,000 from pensions and Social Security can owe less than a third as much income tax as a 64-year-old still saving for retirement, going to work every day, making the same amount of money. Let's take our final break. We'll come back and wrap it up. Let's turn it over to Kristen Snow. Right now, Traffic Center. Kristen. Back to the Jon Sanchez Show on News Talk 780 KOH. All right, let's kind of wrap this up here because we're running out of time very quickly, unfortunately. So hopefully the biggest takeaway that you have of this segment that I've done, or a couple segments I've done on the income tax side of things, your biggest takeaway is this. First of all, if you're feeling down today because you had to write a big check to the government, again, still very early in 2025, lots of tax strategies that you could potentially implement. Obviously, you've understood that a business owner, a venture capitalist, which many of us are never going to be, so on and so forth, have huge advantages, not only on deductions, but also on as I said at the beginning of the show, incredible ways if you're a business owner to shelter money from being taxed and save for retirement and grow tax deferred and so on. So, I get asked this a lot. It's like, why do the wealthy, right? You've heard Warren Buffett say he is in a lower tax rate than his secretary. And you see the likes of Jeff Bezos never paying, or paying a small amount of income taxes on a, percentage of his income compared to everybody else. I mean, you hear all the stories, right? So why is that? Well, it's pretty simple. The wealthy don't earn income. They do not like W-2 income. They love, again, capital gains as much as they can love any tax. Capital gains because it's generally significantly lower than what their ordinary income rate is going to be. Again, they love to borrow and then die, and then no one ends up paying the income taxes on it. There's a lot of different ways they can do it. But they structure their income, and you can too. If you're a W-2 employee, max out your 401k. If you're eligible, max out every retirement account you can. Again, there's many other ways, and I'll do some more shows on this. Even if you're a W-2 employee and you think, oh, geez, I'm stuck at the 23.5 contribution limit to the 401k, I can show you ways that you can actually increase that pretty significantly, more than double that. But again, you have to understand how it's done. For those of you that are business owners, well, I've told you even up until, matter of fact, if you decide to go on an extension today, I can show you a retirement plan that you can put your money into up until the time you file your federal tax return for 2025. So if you got a big tax bill, by all means, have your accountant file an extension, give us a call, and we can, of course, help you on that side of it. But once again, you want to shift from W-2 type of income to business income, to investment income, to tax advantage income. In other words, you want to be in control of the tax side of things. Remember, real estate investing, for those of you that qualify, business ownership, retirement planning structures, estate planning structures, right? All of this comes together. So again, if you find yourself in that, 100 to 200,000 range or more, you are the ones the government loves because you pay a high tax rate. It is time for you to roll over a new page and begin to get involved in tax structuring. If we can help you, give us a call, 775-800-1801, or send me an email at john@sanchezgaunt capital management and or john@sanchezgaunt.com. And love to sit down with you and show you some strategies. Hopefully you have enjoyed it. God bless. Have a great afternoon. We'll see you tomorrow on the Jon Sanchez Show.
Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.